Hi, my name is David Perry. I'm the project manager with the Western Virginia Land Trust, and I'm here with Becky McCoy. Becky, thanks for joining us today. Appreciate it. Becky is a CPA from Mathews, Virginia, and she's very knowledgeable in the tax benefits and the financial ramifications of conservation easements. So we're glad to have you here sharing your knowledge with us today.
Thank you for inviting me.
Absolutely. Becky, explain the difference between a tax deduction and a tax credit.
The difference between a tax deduction and a tax credit is that a deduction offsets income. Okay, a deduction will offset income dollar for dollar. And on a tax return, the ultimate thing you want to get down to is what is your taxable income. So a deduction will reduce that taxable income. After you've reached your taxable income, of course, you have to calculate the taxes that are applicable on that income based on different income tax rates. A tax credit will then come in behind after that tax liability deduction is calculated and offset what you actually owe to either the federal or state government, depending on where the credit falls.
Okay, so the deduction lowers your income that your tax is based on, and your tax credit comes right off the top of your tax bill.
Correct.
In other words. Okay,
Correct.
Great. Now, so we get a federal deduction and a state tax credit. Can you tell us a little bit about the federal tax deduction for conservation easement donors?
Okay. Right now, if you do a conservation easement on your property, the normal taxpayer will get a 50% deduction against adjusted gross income every year. And for the portion of that conservation easement that is not used up in that year, you can carry it forward for up to 15 years before it expires. And this is a great change from what the prior law was, where the deduction was only deductible against 30% of adjusted gross income, and you only had a 5-year carry forward. Now there's a second category that was created that is called a qualified farmer category. And for qualified farmers, they can take the deduction for the conservation easement against 100% of adjusted gross income. And they also get the 15-year carry forward. What makes a qualified farmer is someone who has more than 50% of their gross taxable income from farm activities as defined in the Internal Revenue Code. And it basically has to do with things like agricultural activities and forestry activities. Okay? And you do the 50% income test first. Now, if your easement was recorded after August 17th of 2006, and the easement was done on agricultural property, you also have to, in the easement deed, ensure that the restriction on the property allows for the perpetual use of that property for agricultural purposes. Okay, so it's a secondary tier that you look at on the easement deed.
So that's the federal tax deduction. Now tell us about the state tax credit program that Virginia has.
Okay, Virginia has the most beneficial tax credit program of any of the states in the United States.
Very fortunate.
We are very, very fortunate that our General Assembly is kind enough to give us this as an incentive for conserving your property. Mm-hmm. Under the Virginia law, for every dollar of appraised value of your easement, you get 40 cents in the form of an income tax credit. Now that tax credit can either be used by you as a taxpayer to offset your Virginia liability, dollar for dollar, or if you can't use it for easements that were recorded starting January 1 of 2002, that tax credit is transferable. The tax credit is good for the year when you record your easement, and it has 10 carry forward years before it expires.
Now what if you don't live in Virginia, but you have property on which you've donated a conservation easement?
The way that the law reads in Virginia, you just need to be a taxpayer in Virginia. So in other words, if you own property and you're paying real estate taxes, the Attorney General has ruled that that qualifies as a taxpayer in Virginia. So you could do an easement on your property, you could get these Virginia income tax credits. If you weren't going to use them yourself, you could either gift them to other family members or you could sell them. You can transfer them.
Great. How does one go about selling his tax credits?
There are a variety of different ways that you can sell your tax credits. You can find people to buy them yourself. Mm-hmm. You know, if you have neighbors who could use them. There are a number of facilitators around the state of Virginia. They fall in many different categories. A lot of financial advisors, attorneys, CPAs. There are brokers that will help you to sell your tax credits. The best advice that I can give to a seller of tax credits is, identify these people, interview them and see what type of a program they have for selling your tax credits, because most of these things are driven by contracts between the buyer and seller. And the price in many cases will alter between the contractual relationship of the buyer and the seller. In other words, how many guarantees is the seller going to give to the buyer?
Right, right. So, and I would encourage anybody that wants to sell their tax credits to get in early with a group like Western Virginia Land Trust, so you can really make certain that your appraisal is on target and fair, and that the whole process is very professional and above board, because you don't want that IRS scrutiny.
Exactly.
Down the road.
And there are a number of standards now that we do have some published guidance on, particularly in Virginia, of what is, you know, a good easement deed, what is a good qualified appraisal.
Right.
The IRS actually has given out some guidance on this issue. So we have really good guidance on where you fall within these standards. And a lot of times we have these documents, the easement deed and the appraisal, go through review processes, which then gives some validity to them, because we have professionals who work in this area reviewing these documents.
Right.
And those credits tend to bring more money to the seller. Plus, there's less headache down the road, potential risk down the road.
Absolutely, absolutely. So we've talked about federal deductions and state tax credits. Let's talk about benefits on your estate taxes. What are some of those?
That can be a huge benefit.
Right.
When somebody dies, we have to take a snapshot of everything they own on the day that they die, and we have to value those things. And if the total sum value of those assets exceeds the federal exemption for that year, we have a taxable estate. Okay? And in some cases, if there's a spousal exemption allowed, we don't actually have to pay estate taxes. But in other cases where you don't have any exemption on that taxable estate, you end up in a very, very high tax rate right to begin with.
Right.
Now, if you have a piece of real estate that at its highest and best use is unrestricted, it is going to have a higher value than one that has a conservation easement on it, because you've given up a lot of the rights, so it is a devalued piece of property.
Right.
Also, in addition to that, there's a special exclusion election that you can do. It's on Form 706, Schedule U, that can allow you to exclude up to an additional $500,000 in value from your estate. So you can really significantly reduce the valuation of assets in an estate and come with significant estate deductions.
That's fantastic, and it's something that folks don't think about until sometimes it's too late, and unfortunately their kids are left holding the bag and even having to sell the property in order to pay the taxes on the property, which is an unfortunate irony.
Yeah,
Right.
I've unfortunately seen that in many cases, because real estate values have escalated so much over the last few years, and you have a large number of people who are land rich and cash poor. The family farm or the family property that has been there for generations, several hundred acres, is now worth millions and millions of dollars, and it is the only asset. And in order to pay the estate taxes, unfortunately that property has to be sold.
Right.
Which is a sad situation. And if you did the easement, you might have enough devaluation there that you wouldn't have to sell that family property and your heirs could inherit it.
Right, right.